Hello and welcome. We've put together this guide with the experts over at Pro Tax Accountants, and today we're diving into 5 really powerful ways you can invest your money completely tax-free right here in the UK for the 2025/26 tax year. With the way things are, making your money work smarter isn't just a nice idea, it's absolutely essential. So let me just kick things off with a question for you. Are your savings and your investments actually working as hard as you are? It's a simple one, but it's so important. It's one thing to earn money, but it's a whole other ballgame to protect it and make it grow. And here's exactly why that question matters so much right now. Take a look at this number. £3,000. That's it. That's your entire capital gains tax-free allowance for the whole tax year. Any profit you make above that measly amount, well, it's going to get hit by tax. What that really means is in today's tough tax environment, being strategic isn't just some clever trick for the super rich. It is absolutely essential for anyone who wants to grow their wealth. But don't worry, there is a way to navigate this, and we're going to lay out the plan right now. So here's our roadmap. First, we'll quickly unpack what we mean by the tax squeeze. Then we'll get into the good stuff. ISAs, pensions, government-backed securities, and those high-growth VCTs. And finally, we'll pull it all together into a plan that makes sense. All right, let's get into it. Section 1, the 2025-26 tax squeeze. It's so important to get a clear picture of the landscape we're all dealing with because, you can't win the game if you don't know the rules. So, what is this tax squeeze? Well, it's kind of like a perfect storm. We've got that tiny £3,000 capital gains allowance for starters. Any gains above that can get taxed at a hefty rate, up to 24% for higher rate taxpayers on some investments. On top of that, the income tax bands are frozen. This creates a sneaky thing called fiscal drag. Basically, even a small pay rise can push you into a higher tax bracket, meaning you pay more tax even if you don't feel any richer. It makes these tax-free strategies more crucial than ever. Which brings us to our first line of defense. Section 2, the Everyday Shield, the brilliant ISA. Honestly, you should think of this as your flexible, go-to tax-free bubble for your savings and investments. So what on earth is an individual savings account, or ISA? Well, it's not actually an investment itself. The best way to think of it is as a special container, a wrapper. And the magic of this wrapper is that it makes everything you put inside it invisible to the tax man. No tax on interest, no tax on dividends, and absolutely zero zip nada on capital gains. And here is the big number you need to remember for ISAs, £20,000. That is your generous allowance every single tax year. It resets every April, giving you a brand new chance to fill up that tax-free pot. The benefits here are just fantastic. All your growth is 100% free from capital gains tax. All your income or interest is 100% free from income tax. And, this is the big one, you can take your money out whenever you want completely tax-free. So, let's imagine Maria, a freelance web developer in Manchester. She could use her ISA to save for a house deposit. As her investments grow, she can sleep at night knowing she won't have to hand a single penny of that growth to HMRC when she's ready to buy. Now, here's a little pro tip, and this is where it gets really clever. Since an ISA is just a container, you can use it to make other investments even more tax efficient. We're going to talk about UK gilts in a bit. They're already free from capital gains tax. But if you hold them inside your ISA, the interest they pay also becomes tax-free. It's like getting a double dip of tax benefits. Okay, so ISAs have your flexible savings covered, but what about the really long-term stuff? Well, that brings us to Section 3, your retirement boost, the pension. This is all about building that serious long-term wealth as efficiently as possible. Pensions are amazing. They offer this triple whammy of tax benefits. First, you get tax relief when you pay in. It's basically free money from the government. For a basic rate taxpayer, for every £80 you put in, the government automatically tops it up to £100. It's an instant boost. Second, just like an ISA, everything inside grows free from UK tax. And third, when you finally get to retirement, there's another huge perk waiting for you. And here it is. You can normally take a quarter, 25%, of your entire pension pot as a tax-free lump sum. Let that sink in. 1/4 of everything you've saved, totally tax-free, from age 55, which is rising to 57 in 2028. That is an unbelievably valuable benefit. All right, let's shift gears. Next up, we're looking at investments where security is really the name of the game. In Section 4, we're exploring government-backed options. UK gilts and premium bonds. So what on earth is a UK government gilt? Well, in the simplest terms, you're lending money to the UK government. You give them your cash for a fixed period, and in return, they pay you a fixed interest payment, called a coupon, twice a year. Then, when the time is up, you get your original money back in full. And the best part? The British government has never, ever failed to make its payments. They're about as secure as it gets. Now, the key tax benefit here is huge. Any profit you make from selling a gilt is completely 100% free from capital gains tax. Given that tiny £3,000 allowance we talked about, that's a massive deal. Just remember, the interest payments are normally taxable unless, you guessed it, you hold the gilt inside your ISA. So how do gilts stack up against the other government favorite, premium bonds? Well, this table shows the trade-off perfectly. With gilts, you get a guaranteed, predictable income stream. With premium bonds, it's all about chance. You're entered into a monthly prize draw to win tax-free cash prizes. So you have to choose. Do you want the certainty of a gilt or the lottery-style excitement of premium bonds? Okay, we've covered flexible savings, long-term retirement, and super secure bonds. Now stay with me because this next point might surprise you. Section 5 is all about high-growth investing with something called venture capital trusts, or VCTs. And listen up because this one comes with a deadline. VCTs are a special type of investment where you're putting money into small, up-and-coming UK businesses. Now, because this is higher risk, the government gives you a whole suite of incredible tax incentives to encourage you. Any dividends you get, tax-free. Any profit when you sell, no capital gains tax. And the biggest kicker of them all, a huge chunk of your money back upfront through income tax relief. Right now, that upfront income tax relief is a massive 30%. Let me put that into real terms. If you invest £10,000 into a VCT, you can literally knock £3,000 off your income tax bill for that year. It's an immediate, powerful return. But, and this is a big but, that's about to change. Because from the 6th of April 2026, that incredible 30% relief gets slashed. It's dropping all the way down to just 20%. This is a really significant change that the government has announced. This timeline makes it crystal clear. The clock is ticking. You have until the 5th of April 2026 to get that 30% rate. After that, the benefit drops by a third. So for anyone even thinking about VCTs, there's a real sense of urgency to make a move in this tax year or the next to get the most bang for your buck. Whew, we have covered a lot of ground. So, in our final section, let's bring it all home. Let's put all the pieces of the puzzle together into a plan that actually makes sense. It's all about knowing which tool to use for which job. And this summary really says it all. Your ISA is your flexible Swiss Army knife for accessible savings. Your pension is the absolute powerhouse for your long-term retirement. UK gilts give you that secure, predictable return with no CGT headache. Premium bonds are your secure savings with that fun lottery element. And VCTs, well, they're for the more adventurous investor, looking for high growth, supercharged by that 30% tax relief while it lasts. But here's the thing, and I really want to stress this. Everything we've talked about today is just a starting point. A great starting point for sure, but your personal financial strategy has to be tailored to you, to your goals, your appetite for risk, and your unique situation. And that's exactly where getting some expert advice is a game changer. If you want to dig deeper into any of these options, the team at Pro Tax Accountant are ready to help you out. You can reach them on WhatsApp or by phone at 07985 689912, or just drop them an email at info@protaxaccountant.co.uk. Now for the important disclaimer. The information in this guide is for general purposes only. It should not be relied upon to make financial decisions. Before you do anything, you must consult the tax experts at Pro Tax Accountant. So, the only question left to ask is, are you ready to make your money tax efficient? Thanks so much for joining me.